Okay, so let's start running through chapter 10 here and talk about a little bit about the recording and evaluating a part of the revenue processes. Okay, so if you recall, the revenue process really starts with determining marketing and distribution channels. What are we going to sell? Where are we going to sell it? That kind of thing. Then you're going to receive and accept orders from customers, deliver goods and services to those customers, receive payment from those customers, and then finally provide any customer support related to the items that you sold or the service that you provided. Now, note, these first 2 points, they're not accounting events. We do not record them because they don't impact our assets equals liability plus equity, right? There's no impact on the accounting equation from these, so we don't record them. These last 3, we do have to record. We have to record this transaction because these are accounting events. They do impact assets, liabilities, and equity. Okay. I've got up here in bright red and boxed in bold here that we need to recall that in accrual accounting, we recognize revenue when we earn it. So when we provide the service, when we provide the good to the customer, okay? So let's take a look at an example here. So this is an example of recognizing revenue when cash is collected. And this is something we've been doing all semester already anyways, right? So let's assume that Apple sells a computer to a customer for $2,000. That customer is immediately going to pay with cash. Apple's going to record the transaction with a debit to cash to increase the asset and a credit to sales revenue to increase the revenue, okay? Now let's take a look at an example of recognized revenue before we collect cash, okay? This creates an asset for us. Let's assume that Apple sells a computer to the customer for $2,000 and that customer is sent a bill. Apple's going to record the transaction as follows. We're going to debit accounts receivable. That's the new asset that we're creating. You debit it to increase it. And then you're going to credit sales revenue to increase the revenue there. Now, remember, when we have an accounts receivable, the other end of that is going to be revenue, right? We've provided the service. We've provided the good, whatever the case is, okay? Now, when they actually pay us the cash, we're going to debit cash to increase the cash asset. We're going to credit accounts receivable to decrease that receivable asset. Okay. So let's talk about recognizing revenue after we collect the cash. Okay. This creates a liability for us. Okay. This is that unearned revenue liability. So let's assume that Apple sells a 12-month music streaming subscription for $100. The customer pays them $100 up front. Apple's going to record the transaction as follows, right? So they're going to increase cash with a debit. That increases the asset. They're going to increase unearned revenue with a credit. That is the revenue, okay? Now, after a month's worth of services provided, Apple's going to record, they're going to actually recognize the revenue, okay? So they're going to debit that unearned revenue account. That's a liability, so they're debiting it to reduce it. And then they're going to credit service revenue because they finally earned that revenue, okay? Now, way back in Chapter 8, we discussed the return of a product, right? Right, and we also talked about what happens if you don't return the product, but they give you a discount on it, and that was the allowance, right? So these are sales returns and allowances. We took a look at these in Chapter 8 from the purchaser's perspective, and we recorded them using the gross or the net method. We could choose one. Hey, if you recorded it gross, we're going to assume that the discount's not going to be taken, and we don't record the discount until it's actually happened. Using the net method, we're going to record it as though we are going to take the discount. We're making the assumption that we're taking the discount, okay? In Chapter 10, we're going to discuss these things, but we're going to discuss them from the seller's perspective. So we'll talk about sales returns and allowances, okay? We're only going to record these at gross, okay? Any returns, any allowances, we're going to record in a contra revenue account, and that account is called sales returns and allowances, okay? So let's look at an example real quick. So let's assume that Apple sells a computer for $3,000 to a customer on account. Remember, this is AR. The customer, for whatever reason, is not happy with the performance of the computer, and they contact Apple to complain. To keep the customer happy, Apple's going to offer them a 10% allowance on the computer. This is how they're going to record that, okay? So the initial sale was AR for $3,000, increased with a debit. Sales revenue increased with a credit. Okay. The allowance is going to be recorded as follows, and this should be for $300, not $3,000. We're going to debit sales returns and allowances. Okay, this is that contra account, the contra revenue account, so it increases with a debit. And then we're going to credit the accounts receivable to reduce it by the amount of the allowance. Okay. So Discounts, if we remember, are when vendors will offer a discount for paying on time, right? So, or paying before the due date. So 210 net 30 is how we set it. So 2% discount within 10 days, the full amount's due within 30 days, okay? From the seller's perspective, it's called a sales discount, and it's going to be recorded as follows. Let's assume that we make a credit sale of $30,000 with terms of 315 net 45, okay? So we make the AR, $30,000, increase it, and then we're going to increase sales revenue by $30,000 because we provided the good to them. We've already given them the computer. Now we're just waiting on them to pay. Now let's assume that the customer pays within the 45-day period, okay? Excuse me, this should be within the 15-day period, okay? So the sales discount is going to be for 3% of the cost. So you can take 30,000 times 0.97, and that gives you $900. So you're going to record the sales discount at $900. The actual amount of the cash that you're getting is $29,100. That was the minimum amount of cash that the customer had to give you. And then we're going to decrease the AR account by $30,000, right? We're going to decrease it by the full amount, okay, because they no longer own it, no longer owe us that money, okay? We record the discount taken by the customer in a temporary account called sales discounts, okay? So now we're going to talk about the relationship between inventory and cost of goods sold. So if you remember, we talked about the COGS model a couple chapters ago. That was your beginning inventory plus your purchases equals your cost of goods available for sale. You reduce that by your cost of goods sold, and it gives you your ending inventory. And that's what we're looking at right here, right? You have a beginning inventory of 20,000. You add your purchases, that's 90,000. So your inventory available for sale, your cost of goods available for sale is 110,000. Any inventory that you don't sell ends up in your ending inventory. Any inventory that you do sell ends up in your expense. So this is the COGS model at work. When we come into the next video, we'll start talking about FIFO versus LIFO. These are different ways that we value inventory.